Good evening, everyone, to part 3 of financial instrument. And I believe this will be our last part in order to wrap up our discussions. Part 1, we discussed extensively on financial instrument presentation, where we look at the requirement of IS 32. And thereafter, that led us to discussion on IFRS 9. And IFRS 9 entails the following. First, we discussed about recognition of financial instruments, and upon recognition, we carry out a classification. And we also discussed about that. And also, we discussed about measurement, initial measurement and subsequent measurement. And we wrap up the class at that level. Now, the final and concluding part will be a discussion on the recognition and also discussion on derivative valuation and accounting. We'll move further to discussion on embedded derivative. We more or less discuss extensively on impairment of assets, which is very key to IFRS 9. And we also look briefly on discussion on edge accounting. And we are going to wrap it up with disclosure requirement in line with IFRS 7. And briefly talked about fair value measurement, IFRS 13. Now, if you remember, yesterday we have a simple discussion about classification or grouping of financial assets. And in that discussion, we are able to identify that financial asset has 3 categories and financial liability has 2 categories. Okay, which is this. Okay, we said financial asset could be classified into fair value to profit or loss. It could be classified as amortized cost, and it could be classified as fair value to other comprehensive income. And we went through the steps to be followed in order to identify the appropriate class of financial assets. We also further discussed on financial liabilities, which has 2 classes. The first class is the fair value to profit or loss, while the second class is the amortized cost. Okay, and we went further to also look at steps or a flow chart in order to have understanding of how we group or classify financial instruments. And we went further to discuss initial recognition, where we make a conclusion that all financial assets have to be measured at initial recognition at fair value, and likewise financial liability. And subsequently, the measurement, whether at fair value or at amortized cost, is dependent on the class of asset or liability. And also the impact of the recognition of fair value gain or loss will also be based on the class of the financial asset or financial liability. And we all said that fair value movement or changes does not affect those financial assets classified as financial, as amortized cost. Okay. Now today we are going to start with the recognition. We are going to start with the recognition. Okay. Now, before I start with the recognition, I want to reiterate what we displayed yesterday when we had extensive discussion on amortized cost, okay? And we practicalized it with about 2 or 3 examples. And again, I'll reflect to us that what is amortized cost in its real sense. Now, what we did yesterday is summarized by this slide so that you can be able to picture the practical aspect of applying amortized cost measurement to the theoretical aspect. And when you look at what is board, you find out that amortized costs rely on the effective interest method. Secondly, the effective interest method produces the fair value, the effective interest rate. And we said yesterday that the effective interest rate is synonymous to obtaining IRR, which is internal rate of return, or obtaining what we call the yield to maturity. And therefore, that is it. And how do you obtain that? You obtain it by trying to approximate the present value of cash flow that were invested with the present value of the outflow, which means you are looking for a rate that makes sure that at the end of the day, the difference between the present value of inflow and present value of outflow will equal 0. And that is the position of the standard. Now, let us now move to the first discussion today, which borders on the recognition of financial instruments. Now, when we talk about the recognition, it means you are looking at a process or a situation where you no longer recognize an asset, a financial asset or a financial liability in the books of a company, which means it is the whole process of removing from the balance sheet of a company an item of financial asset, an item of financial liability. And that's what we mean by the recognition. Okay, similarly, if you remember, recognition is the means of introducing or accounting for financial assets and financial liability in the books. Which that means that at what point do we derecognize? And how do we derecognize? And what is the effect of such a derecognition? That is what we are going to discuss. Now, the derecognition principle for assets is such that you derecognize assets when the significant risk and reward have been transferred. What does that mean? It means that, for example, if you disposed of a financial asset, you have already transferred the significant risk and reward as a result of the disposal. Another way you can transfer the risk and reward is similar to when you more or less carry out what we call a repo transaction, a repurchase transaction. What does that mean? It's a form of securitization, whereby I might have a security, but because I'm in need of money today, I can more or less sell such security to another party with the agreement that I'll purchase it back. Therefore, the question then is, if I have such a transaction, it is called securitization, which means I'm only pledging that asset as if it's a collateral for borrowing. Because how will I say I want to sell my treasury bill and I'm still entering into a contract to buy it back from you after 20 days? The question then is, what I'm simply doing is that I am pledging that security as a collateral for the money I'm collecting from you. Okay, but in this real sense, we need to look at some other factors to be able to conclude whether I have been able to transfer the significant risk and reward substantially, or I still retain it, which means it's a function of whether I retain the substantial risk and reward or I've transferred that will determine whether I will be recognized. Okay, which then means that if from a repo transaction of such, it is deemed that substantially I've transferred my risk and reward, in that case, I would recognize the financial asset. Otherwise, I will still recognize it as a financial asset, and I'll recognize the money I collected as a form of borrowing. Okay, that is the simple process we follow. Therefore, I can show you 3 steps that we can use in practice to recognize financial asset. The first step is that we decide whether the asset as a whole or in part was transferred or not. Which then means that if I ask myself a simple question, these financial assets, do I still have right to it? If the answer is yes, it means it has not been transferred. But if the answer is no, it then means, how did I transfer my right? Is either I transfer my right by selling it, or I transfer my right by pledging it, like a form of securitization I explained. Now, the next step is to determine whether risk and reward on that financial asset have been transferred along with such a transfer I've made, which means, have I been able to substantially transfer the risk and reward? If the answer is simply yes, it then means that I have to go ahead to derecognize it. If the answer is no, therefore it means I have to still retain it in the books, which means any money I've received will be deemed to be a form of borrowing, which is repayable at a later date. Now, step 3 now concludes that if you have neither retained nor transferred substantially all of the risk and reward of the asset, then what do? You need to assess whether you have retained a control or not. Which means if you retain control, it then means you have not effectively transferred, even though physically you might have transferred. And in that case, you don't recognize. It's only when control is no longer retained that it is deemed that you have transferred. And at that point, would you recognize a financial asset. Now, when you recognize a financial asset, you recognize it based on the value obtainable as at the time of transfer. And the difference between the value obtainable at the time of transfer and the value or carrying amount before transfer result into a gain or loss in your profit or loss. Now, for a liability, it's similar. Now, when do you recognize a liability? It's when you no longer have obligation for that liability. When such obligation is no longer in existence, or such obligation has been extinguished. Now, obligation can be extinguished under three conditions. The first condition is that it can be extinguished once you are discharged of that obligation. When are you discharged of an obligation? You are only discharged of an obligation upon settlement. That is when you have paid back that obligation. For example, I borrow money from you or from a bank, and at the maturity date, I make payments to the bank. Therefore, such obligation is deemed to have been discharged because I've made payment. When is an obligation considered to have been cancelled? This is always by the order of court or litigation, whereby we have dispute about a liability, and that liability at that point in time, by order of court, I'm discharged that I'm no longer liable or having obligation. Or a situation where I owe 5 million, but because I've not been able to pay for some time, the other party is interested in me paying promptly, and the other party agrees to take 4 million naira in full and final settlement of that 5 million naira. At that point in time, 1 million aspect of it has been cancelled, which means if I pay 4 million, it will be deemed to be full and final settlement. In that situation, 1 million part of liability have to be recognized because it's no longer required to be settled, which means it has been cancelled. And when it expires, it's less common, which means if you have an obligation in which the other party have to ensure that such obligation is considered payable or is considered realizable as at that point in time, but as a result of time lag, such obligation expires, which means I no longer have an obligation to settle. At that point in time, it expires, which means three conditions that can warrant the recognition of financial liability is upon discharge, which means settlement, upon cancellation, which means by way of reduction of liability or by order of court, and when it expires, which is as a result of time lag. Therefore, the value as at the point of the recognition will be compared with the carrying amount prior to the recognition, and any gain or loss arising from such the recognition will be recognized in your profit or loss. Now, also we have what we call, you can see this chart if you follow the process through. Once you're able to answer all these questions, either yes or no, it leads you to the point for you to now conclude on the recognition. Okay, now we also talk about reclassification. Now, what is reclassification? Reclassification is taking a financial asset from one bucket to another. For example, financial assets has three buckets: fair value to profit or loss, amortized cost, and fair value through other comprehensive income. The question then is this: can I reclassify a financial asset that already exists in fair value to profit or loss to amortized cost? Or can I classify from amortized cost to fair value to profit or loss? Or can I classify from fair value to OCI to the other party? Now, in this case, the only reason why you can classify is conditioned upon change in business model, which means if business model has not changed, you cannot classify or reclassify. Now, also, which then means that, for example, if I have a debt security which has contractual cash flow, and by default, upon my initial recognition, it was classified as amortized cost. Now, if in this case, we discover that the business model has changed, it could warrant it to be reclassified from amortized cost to fair value to profit or loss. Okay, but it is unlikely that you can reclassify from fair value to profit or loss to amortized cost. Okay, and also IFRS 9 does not allow reclassification for equity investment that is measured at fair value to OCI, which means if you have equity investment measured at fair value to OCI, you can no longer reclassify it as fair value to profit or loss. And neither can you reclassify from amortized cost to fair value to OCI, which means reclassification along the side of fair value to OCI is somehow restricted, okay, or not permitted. But you can see more often reclassification from amortized cost to fair value when the business model has changed for a debt security. And for fair value to profit or loss, you can classify to amortized cost if the model has also changed such that you no longer want to sell to realize the value of the asset, but rather to hold it to collect all of the contractual cash flow at those specified dates. Okay, and that is that. And lastly, on no condition can you classify equity investment from fair value to profit or loss to fair value to OCI or to amortized cost. Because again, equity cannot reside on amortized cost because equity does not have a contractual cash flow. Therefore, how do you now report the gain or losses arising from such a reclassification? Because what it simply means is that if I want to classify a debt security at amortized cost to fair value, now before I'm carrying the financial asset at amortized cost, which means I subject it to effective interest rate measurement, and what I have as the value, I will have to compare it with the fair value upon the date of reclassification, which means fair value will be the new value of that. The question then is, the fair value might vary from the amortized cost, which means it can be more or less, which results into a gain or loss. The question then is, how do I report the gain or loss? If a financial asset you classify from amortized cost to fair value, such a gain or loss arising from that reclassification will have to be recognized and reported in your profit or loss. Okay, and also, if you classify from fair value to amortized cost, the fair value differential as at the date of reclassification, okay, will also impact your profit or loss, whereas the fair value as at the point of reclassification will now become like the original carrying amount as at that date of classification. And that is that. But one principal thing you need to take note is that it's unlikely to reclassify from fair value to OCI to other classes. But you can classify within fair value to profit or loss to amortized cost and amortized cost to fair value to profit or loss. But one singular factor that you must consider for such a classification to be valid is that the business model has changed. Okay, if business model has not changed, such a classification is not permitted. We might look at situation or scenario where business model has changed and where such a classification is permitted. Now let's look at two scenarios. Now the first scenario is this. Let's see an entity that has a portfolio of commercial loans, and this portfolio of commercial loans are held for sale in the short term. That is the strategy of that company. And the entity acquires a company that manages a commercial loan, which means that entity now go further to acquire another entity that manages similar commercial loan, but in their own business model, they manage it such that they owe the loan up to maturity to collect all of the contractual cash flow, interest and principal over the specified dates. Now, the question then is, this, upon the acquisition, there's now an integration between the acquirer and the acquirees, such that the new portfolio now is managed collectively with the hope of holding it to maturity, such that you collect all of the contractual cash flow. In that case, what has simply happened is that as a result of a business combination, you find yourself in a situation where you now have to collapse the portfolio together because they have different business model, but now you only maintain one single model because you are now a single entity. In that situation, you have now opted for the model that will collect and that will hold and collect all of the contractual cash flow over the life of the commercial loan. In that situation, you will be forced to reclassify those portfolio you already carried at fair value to profit or loss to amortized cost. or because as a result of business combination, it has forced you to change your business model of one to the other for you to have a synergy. Okay, another example where such classification is permitted based on business model is, let's look at a financial service company. And that company has decided to more or less shut down, okay, shut down their, or delete their retail mortgage business, which means they have commercial loan, they have retail mortgage business, they have corporate finance unit and all other things. But they have decided that a particular division, which is the retail mortgage division, have to be shut down. Now, that business no longer accepts new business, and the financial service firm is actively marketing such a portfolio. Naturally, if this has not occurred in this light of trying to shut down and trying to market it so that you can discontinue that portfolio, this asset primarily will have been carried at amortized cost because it qualifies for amortized cost based on the two tests that will have carried out. Remember the two tests we discussed earlier, business model test and the contractual cash flow characteristics test. Now, on that basis, you will have carried that amortized cost. But because we have changed our business model such that we discontinue such a division, and we are actively in the process of looking for a buyer of the existing portfolio so that we no longer carry such portfolio. In that situation, we will consider that such a reclassification from amortized cost to fair value is permitted. But there are other situations whereby there's a change in motive, but not a change in business model. Okay, now let's see a practical example. Now, when you have a change in intention, which is your motive for a particular financial asset, that does not bring about change in business model. Okay, that is just a mere change of intention or a mere change of motive underlining holding that financial instrument. And in that case, the circumstances or other things have not necessarily changed other than market conditions. Okay, now the second one is that what if you are in a situation where you have a financial asset that before now is actively traded and you measure it at fair value. Over time, for a period of 3 months, such security is not traded in the market because no willing buyer, no willing seller. And for a short period of time or temporarily, the market value, the market pricing more or less disappear from the market, which means it remains the same amount over a long, don't let me use the word long, over a short period of time. And you now believe that on that basis, you can no longer hold that fair value because there's no basis of measuring that fair value. And therefore, you wanted to reclassify to amortized cost. Such will not be permitted because it's a temporary disappearance. It is not a permanent disappearance. And finally, a situation where you have transferred financial asset between parties within an entity, such would not warrant a change in business model. Now, unlike the commercial loan that we looked at earlier, whereby entity A manages the portfolio differently from entity B, and as a result of business combination, entity A acquires B, and they have to more or less collapse the portfolio together as one. That is a different scenario. But let us look at a scenario where we have a single entity, but that entity has more than one division. And when we look at it, Division A managed portfolio separately, Division B managed portfolio separately. Now, what now happened at the end of the day is that you decide to collapse the two divisions. Remember, the two divisions already exist within that entity. We are not collapsing the two divisions such that you now have to more or less take one class and move it to other class. And we said, no, that is not possible because it's still within the same entity. The business model has not changed. What has changed is the intention or motive, which does not necessarily change the business model. And in that situation, such a classification cannot be allowed. Okay, other consideration is reclassification of financial liability is never permitted. No condition can make you reclassify financial liability at any point in time, which means once upon initial recognition, you have more or less had a classification as either fair value to profit or loss or as amortized cost. Subsequently, nothing can change the reclassification. Nothing can change the classification, which means reclassification in that situation will not be permitted. Other time is that reclassification of equity instrument is not permitted. I've said that earlier. By default, you can't classify equity. There are two buckets in which equity instrument falls. First, it could be fair value to profit or loss or fair value to OCI. Therefore, on no basis can you cross it, under no condition. And that is the important thing we need to know, which then means we've been able to explain the recognition principle, and we are able to explain reclassification principle. At this point, if you have any question or clarification, kindly indicate by raising up your hand on the platform so that I can unmute you and you ask your question. Anyone raising up hand? If not, we can proceed to the next discussion. Anyone raising up hand? Okay, we move further. Now we'll discuss derivative again. 2 days ago, which was part 1, we more or less introduced derivative. We said derivative is a special form of financial instrument. Why is it special? Because derivative has no value of its own. Rather, it relies on the movement in the value of other variables, which we call underlying. Which then means that when you write a derivative contract, upon initial recognition, is usually of no value, or at least is of a small value, which we discuss under option, where you have to pay a price, option price or premium, or in a forward contract where you have to put up initial margin. Okay, those are the only situation where you invest a little amount, but at other point, under swap and forward, you invest no amount. Okay, and remember, we said derivative is a contract such that it's between two counterparties. The word counter is essential. Why? Because somebody is saying something going up, the other person is seeing that thing going down. Therefore, you have not come to more or less hedge and speculate your risk. And at that point in time, the same thing I'm looking at, which you are also looking at, I'm seeing it going up, you are seeing it coming down. Therefore, we try to exchange our fears. And that's how you consummate a derivative contract. And we said derivative has the following qualities. 1, it is a contract that is entered into today, but requires future delivery or settlement, which means every time agreed today is not meant for spot transaction. Rather, it's meant for future delivery. Okay, second one is that when we talk about derivative, we are saying that it gives an zero-sum game. A zero-sum game means that the gain to a party is a loss to another party, which means at every point in time, when you net it off, is 0, which means the exact loss I have as a result of the derivative contract is the exact gain you have as a result of derivative contract. Okay, another thing we'll discuss about derivative is that upon initial recognition or when the contract is entered into, the value is usually 0, except in a rare situation of options. Okay, those are the things we mentioned as part of the qualities of a derivative. We also went further that derivative can take 2 forms. First form is that it could be a contingent claim. A contingent claim is where you have an option as a contract. Okay, option as a contract is one of the types of derivatives that are used in the market. Now, it could also be a forward commitment. A forward commitment has 3 types of derivative contracts. The first one is the forward contract. The second one is the futures contract. The third one is the swaps contract. And we also explain those. If you have missed that class, you can go to part 1 of this financial instrument series to have better appreciation. But what matters at this point, which we are to discuss, is how do we measure a derivative? And how do we account for such a measurement? Now, if you remember earlier in our discussion in series 2, which is part 2 of financial instrument, we said all financial instruments upon initial recognition must always be measured at fair value, which means derivative is not an exception. It will be measured at fair value. And I've told you that the fair value of derivative upon initial recognition is usually 0, except for some situations, such as when you have an option contract, okay, where you might have paid a premium, which creates a fair value different from what is 0. But as time moves on, the activity, the movement in the underlying will determine whether it is a gain to you, which creates a derivative asset, or is a loss to you, which creates a derivative liability. Which means whenever your contract, at every point, you evaluate it, and it depicts that you are making a gain, in such a situation, you are creating a derivative asset, which means you debit gain on fair value of derivative, and you debit, your derivative asset, and you credit your gain on fair value of derivative, which is an income. Conversely, if it's a loss, you debit your loss on fair value of derivative, which is like an expense, and you credit your derivative liability, which is a liability in that case. And remember, we said we have 4 types of derivative: futures contracts, forward contracts, swap contracts, and option contracts. And for you to have better understanding of that again, refer to part 1 of financial instrument discussion. Now, subsequently, derivative will equally be measured at fair value, which means initial recognition, which is the first time you measure it, it was measured at fair value. Every reporting date, provided you are still party to that derivative, it will be measured at fair value. And as we have said earlier, we said fair value at this preliminary level is synonymous to market price of an item. Therefore, what that means that if the market price was 10 naira yesterday, which I put in my books, today the market price is 13 naira. I have to show 13 naira in my book, either as derivative asset or liability. The difference between 12 naira and 13 naira represents my gain or loss on the derivative instruments. Okay, and that is that. And at all point in time, the bucket derivative default into is the fair value through profit or loss. There is no condition present today that could warrant you to classify derivative other than in the bucket measured at fair value through profit or loss. And that speaks to the fact of derivative. Now, we now have what we call embedded derivative. Now, derivative is a financial instrument on its own. Now, what is the relationship between derivative and embedded derivative? Now, let us separate it into the prefix and the suffix. Now, we have embedded and we have derivative. Now, as we assume at this point that we have better understanding of what derivative is. Now, what is embedded? The simple language of embedded, or the simple interpretation of embedded by English dictionary, means there's an attachment to something, which means when something is embedded, it means there is something that serves as a host in which this derivative is attached to. Okay, which that means that embedded derivative is a single contract that has 2 components in it. Okay? Now, these 2 components are made up of 1, the host contracts, which are usually non-derivative contracts. And the second thing, which is the second component of it, is derivative. By the time you have a host contract and you have a derivative written on a host contract, what you have simply created is embedded derivative. Now, let me give you a practical example of embedded derivative. Now, embedded derivative is one of the hybrid contracts we know. That is, hybrid contract is when you have something like 2-in-1, similar to when we discussed compound instrument in part 1, where it has element of equity and element of liability. Similarly, this hybrid, which is embedded derivative, have 2 components or elements. Element of host contracts, which are usually non-derivative contracts, and element of derivative contracts. Okay, now let me give you a practical example in this case. Imagine you have a construction contract. Okay, a construction contract is a normal contract, which you call host contract, a standalone contract. But this construction contract is entered into in a foreign currency. But that contract will be executed in your local currency. Therefore, you are now exposed to volatility in exchange rate. Therefore, you now try to write a derivative on that construction contract in order to hedge the volatility risk inherent in that contract. And you have done that not as a separate instrument, but as a whole in that contract. In that situation, we say we have an embedded derivative contract, which contains a derivative written on the construction contract on its own. Another way you can have a derivative is on leases. Now, a lease contract is where you have agreed to obtain a right of use of an asset from the lessor. And you have agreed that you are going to lease this asset for 5 years, for example. Now, you have agreed to pay minimum lease payment of so much over 5 years. But in the lease, part of the condition given by the lessor is such that your minimum lease rental will be inflation adjusted. What does that mean? It means if it's not inflation adjusted, probably you'll be paying 5 million every year for the next 5 years as a lease. But I'm not saying that as a lessor, I'm looking at it that inflation is rising every day in Nigeria. Therefore, 5 million today is not the same thing as 5 million you pay me in 2 years' time. It's not the same thing as 5 million you pay me in 5 years' time. For me not to lose my purchasing power, I can inflation index my minimum rentals. And what does that mean? It means in that situation, the lessor will say, for every time inflation rises above certain basis points or above certain level, the minimum lease payment will be adjusted for that inflation differentials, which means there's another level of risk that is embedded in it. I remember we said derivative is any contract that derives its value from an underlying, which then means that the addition or a form of contingent rent, which is the addition that is attached to such a contract, has created a derivative along with that contract. And in that case, we say such is an embedded contract. Now, a practical example of host contract could be you have a debt security on your own, you have equity investment on your own, you have a service contract on your own, you have a lease agreement on your own, you have a purchase contract or a firm commitment on your own, or you have an insurance contract on your own. But we also know that we have derivative, which come in form of forwards, swaps, options, and futures. Even though we can customize it, there are still customization of derivative in terms of exotic options, in terms of writing options on swap, writing options on futures, writing option on option, and also of things like that. But those ones are advanced level of securitization or synthetic creation of instruments. Okay, but in this case, we are saying that whenever you attach a derivative to an host contract, in that situation, you have what we call embedded derivative. Now, when we have embedded derivative, what is our concern? Our concern is this: should we measure embedded derivative, which is the host contract and derivative, should we measure it as a single contract? Which means in my measurement, I'll take them as one and I will measure it at fair value. Or there's a need for me to split it into individual components component of host contract, and component of derivative. Now, if I split it, derivative will always be measured at fair value because we have made that conclusion earlier. But the host contract will be measured on the basis of the nature of that contract. For example, if the host contract is a debt instrument, which we mentioned earlier, and it passes the business model test and the contractual characteristics test, it then means that such debt instrument naturally as a host contract will be measured at amortized cost. Which means by the time I split the embedded derivative into debt security host contract, I measure it at amortized cost, and derivative, which is option written on it, I measure it at fair value. Similar to others like lease. You separate the lease, which is the right of use of assets, from the derivative. You measure lease in line with IFRS 16, okay, while the derivative, you measure it in line with IFRS 9 at fair value. But again, we are saying that there are some contracts whereby if you separate the host contract itself is measured at fair value. And derivative also is measured at fair value. Therefore, there is no need for us to split them. Because if I split them and I measure host contract at fair value, and I split the derivative and I measure it at fair value, it's still fair value, which means the summation of it will still approximate me measuring that singular instrument at fair value. Which then means that if the economic characteristics of the derivative contract and the host contract are similar, such separation may not be required. And if both derivative contract written on a host contract, both are to be measured at fair value, such split will not be required. Which then means that you must consider the condition that allows you to either separate into host contract or derivative before you can decide on the measurements of such. And that is a simple understanding we need to know with respect to embedded derivative. At this level, I will entertain questions on derivative contracts and its measurement, and embedded derivative contract and its measurement and accounting. Any question at this level? Kindly raise up your hand if you want to ask a question or you want to make a contribution. Anyone? Okay, no one at this point. Now, we get to much more crucial or critical aspect of financial instrument, especially under IFRS 9, impairment. Now, I believe we are familiar with impairment under IAS 36. How does that differ from impairment under IFRS 9? IAS 36 deals with impairment of all other assets other than a financial instrument, which means it deals majorly with impairment of a non-current asset. Okay, a non-current asset includes items of PPE, items that fall within intangibles such as trademark, brands, software, R&D, including corporate assets, including goodwill that arose from a business combination. All of these are contained under IAS 36. But the general notion and principle of impairment remain the same, which speaks to the fact that you are unable to recover all of the carrying amount, and therefore you have suffered a loss. The loss is the excess of the real value of that asset over what you can recover from that asset. And we say such an asset has been impaired. And the excess of that carrying amount over the recoverable amount is deemed to be the impairment loss. Now, that principle is what we still apply under IFRS 9, but the methodology for carrying out the test is slightly different because of the nature of the assets we are subjecting to impairment test. The assets we are subjecting to impairment test under IFRS 9 are financial assets. And we all understand what financial assets are. Okay, as we also move further, the single model that is adopted by IFRS 9 for carrying out impairment on financial assets is what we call the ECL model. It's what we call the what? ECL model. ECL. ECL means expected. C means credit. And L means what? Loss model. Okay, what it simply means is this. Unlike under IAS 39, which was the old standard, that will make use of what we call the incurred loss model. Incurred loss model says that it's only when there's an impairment trigger, like something has already happened, before we can test such financial asset for impairment. But that failed us during the period of global financial crisis. And that was what prompted the massive change in the recognition measurement of financial instruments. And that is what gave birth to IFRS 9. And what has happened now is that it was discovered that the old model recognizes losses late in time, so that the deed would have been done, would have been less prudent as at the time it occurs. Therefore, it is belated. And we now rather say, rather than wait until it occurs, let us start to consider, based on our experience, that something is going wrong, even as at the time we enter into that contract, or something may go wrong, even when we enter into that contract. And also, we should anticipate, based on various factors, of the likelihood that we will suffer a loss. And those factors include our historical experience. Those factors include our current condition, macroeconomic variables, conditions associated with the borrower, and also look at future expectations. All of these are what we consider in order to more or less consider what is the likelihood of a loss and how much of a loss are we going to recognize. And we'll subject it to various states of nature. That's where probability comes into play. And that is how we derive what we call expected. Expected means it may not necessarily have occurred, but it is expected that it will occur given certain conditions. And that is what the model is talking about. And as we move on, we will see the beauty of the model. Now, not all financial assets will be subjected to impairment test. I repeat, not all financial assets will be subjected to impairment test. And it means we cannot apply ECL model to some financial assets, or because they are not subjected to impairment test. Why? One, all financial assets that are measured at fair value to profit or loss will never be subjected to impairment. We discussed that yesterday, briefly. Can anybody remind me or explain why financial assets classified and measured at fair value to profit or loss cannot be subjected to impairment? I'll need an answer. Can somebody raise up hand and try to answer that? Okay, let me unmute you. Okay, can you contribute?
Because fair value is measured at each reporting date.
Because what?
The fair value of the financial asset reported through profit or loss is measured every reporting date.
No, that's not necessarily the reason. Alabi?
Hello, sir.
Yes?
Because
Can you speak up? Can you speak up, please, to your phone or to your laptop?
Okay, because measuring financial assets through profit or loss, fair value through profit or loss, has already captured the impairment. If you have measured the financial asset through profit or loss, the asset has already been impaired since you are using the market price as at the reporting date.
Okay. I want somebody to explain, how was it captured? Because you have measured it at fair value. Agada, can you unmute?
Oh, no, I wanted to say something, but that's exactly what Darius said. So it's a different thing.
Okay, Ireti.
Okay, so to the best of my understanding, I would think that since you're measuring the financial asset through profit or loss, the gain or loss, the movement would already have been recognized in profit or loss. So
okay,
the movement I feel would have been recognized already. So there should be no reason for an impairment since the rise and fall in the prices would have been recognized in profit and loss already.
Thank you very much. That answers the question. Okay, now if a financial asset is truly impaired, the market valuation will have taken that into consideration such that it will have fallen in value in the market, which will have resulted in a fair value loss. And remember, fair value changes, whether loss or gain, on a financial asset measured at fair value to profit or loss would have been recognized directly in profit or loss. And impairment itself goes to profit or loss. Therefore, it's already embedded. And such impairment assessment is not required or no longer required. And that is that fact. But all other financial assets can be subjected to impairment under ECL model, IFRS 9. They include financial assets that are measured at amortized cost. They include financial assets that are measured at fair value through other comprehensive income. But you have to be careful about that when it comes to equity. Mere experiencing a fair value loss on equity investment carried at fair value to other comprehensive income may not necessarily mean that it has been impaired. But it is only impaired if that loss is considered to be of a permanent in nature, and therefore is subjected to impairment assessment. But for every other category of financial asset under fair value to other comprehensive income other than equity investment will outrightly be subjected to annual impairment assessment. When you have loan commitments, especially when there is a present obligation to extend that credit, you have to subject it to impairment, except if by way of your accounting policy, you have already designated it to be measured at fair value to profit or loss. And remember, anything measured to fair value to profit or loss will never be subjected to impairment, as explained by Ireti. Okay, and again, those items that you also subject to are financial guarantee contracts, are lease receivables that arose from IFRS 16, no longer IAS 17, and contract asset that will have resulted from your revenue from contract with customers under IFRS 15. All of these are subjected to impairment, which means in primary sense, when you have bond investment, debenture investment, treasury investment, trade receivables, lease receivables, all of these will be subjected to impairment test at every reporting date. But when you have equity investment, it will not be subjected to impairment, especially when it is measured at fair value to profit or loss. The only point in time you can measure equity for impairment is if it falls under the category of fair value to other comprehensive income and it has continued to experience fair value loss and is considered to be permanent. Otherwise, you won't subject it to impairment. And take note, whenever you subject equity investment to impairment under the category of fair value to OCI, no matter the future condition that restores such equity, such impairment loss cannot be reversed. That is why the standard says that before you subject equity under that category to impairment, it must be considered of a permanent nature, because such impairment loss can no longer be reversed. But generally, other than that, when you subject an asset to impairment and it suffered a loss, there's a loss on that financial asset. Subsequent period, you carry out a reassessment. It is possible that you can recover your initial loss, which means you can have what we call impairment gain in the current period, or because the condition that was negative before has now become positive, which means it's a situation where the dry bone has risen again. And in that situation, we say we have a reversal of an impairment, which we call impairment gain under IFRS 9. But that gain or impairment reversal cannot happen when it comes to equity investment, because it is said to be of a permanent nature. Okay, that is that. Okay, now let us now look at the methodology, which means the ECL model, expected credit loss model. How do we subject a financial asset to impairment under this model? Now, this model, first of all, recognizes that we need to look at the approaches of subjecting an asset to impairment. There are two approaches in principle that can be adopted. The first approach is what we call the general approach. The general approach is the default approach which all financial assets are supposed to be subjected to for an impairment assessment. Okay, but apart from the general approach, we also have what we call a simplified approach, which is an alternative approach to the general approach. And what is this telling us? It's saying that rather than go into step-by-step or stage analysis of impairment under general approach, we rather use a simplified approach. Example of a simplified approach is provision matrix. We'll discuss that today. And a simplified approach is only adopted in a situation that does not require this strenuous way of carrying out impairment. It's like, I use the example of sledgehammer. If you want to kill a rat, or you want to kill a dog, or you want to kill an animal that is strong, you can use a sledgehammer. But can you use a sledgehammer to kill an ant? Not that the sledgehammer will not kill an ant, but the problem is that you will kill the ant and even damage the floor, which means you can use your foot to kill an ant, which means what matters is that the ant is dead, not the means to which you want to kill it, which means why will I exert more energy in doing something that is little? And that's what simplified approach is saying. It says if it is practically expedient to use a simplified approach, therefore use a simplified approach rather than use a general approach. But by the time I take you to a general approach, you will understand the rationale why a simplified approach is created. Okay. Now, what is a general approach? Now, general approach will show you that there are three stages in which a financial asset is subjected to impairment. There's stage 1, there's stage 2, and there's stage 3. Stage 1 is considered to accommodate every financial asset as at the time you create such an asset. Which means every financial asset will be subjected to impairment test under stage 1. Which means if you give loan today, that loan falls under stage 1 for impairment test. Even if the person you gave the loan have the highest quality and credit rating. If you have receivable, trade receivable, with interest component embedded in it, or lease receivable with interest component embedded in it, they also fall under stage 1. Now, stage 1 more or less accommodates those that are considered good financial assets. But when you start to experience deterioration, or when you start to experience what we call significant deterioration in the credit quality of that financial asset, therefore, you now need to graduate that financial asset and take it out of stage 1 and put it in stage 2. Stage 2 means that there are financial assets that have less quality than those in stage 1. And that is based on information that is available before you as at the measurement date. As at the date you are carrying out this test, which is usually at the reporting date, to say, what are the conditions that you are seeing? For example, many financial assets that you owed as an entity before COVID, by this COVID, most of them will have been classified as stage 2. Because even if that person was strong before, COVID pandemic has already eroded its business. Some business has even went down because COVID has taken them out of the economy. Therefore, which means such condition is prevalent. And may somebody paying you your money as at when due and you still have outstanding balance that are not yet due does not mean there is no significant deterioration in credit risk. Therefore, in that case, you have stage 2. Now, stage 3 is the worst stage that you can ever have for a financial asset. And that stage only accommodates every financial asset that are credit default. What does that mean? It means it accommodates financial assets that are already in default. And we are going to see the condition that make a financial asset already in default. And the standard put it as does that a financial asset is already in default and it belongs to stage 3 if there is a loss event. Now, when can we say there's a loss event? A loss event could occur under these following conditions. Once the other party to the financial asset, the person we gave the money to, started to experience significant financial difficulties. Interest that is due over 90 days has not been paid till today, or paid in part. Principal portion has not been paid for some time. This is already a trigger that shows that there's a loss event. If there's a breach of contract between you and the other party so that it is affecting your collection of cash flows, there's a loss event. If you have to grant concession that normally, under a normal condition or an ideal situation, you wouldn't have given such a concession. Like the concession most banks are giving some debtors now as a result of COVID-19, so that some are even seeking moratorium of additional 18 months. Therefore, in such a situation, there's a loss event. When it is highly probable that the borrower will be declared bankrupt or is in the process of bankruptcy, or is in the process of receivership, there's a loss event. If you have investment in a financial asset, such as debt security, and suddenly the market became inactive and is of permanent nature, so that there is difficulty in even selling that asset in the market because there's no willing buyer. Market no longer exists for such. It shows there's a loss event. And finally, there's a loss event on you purchasing a default financial asset. I'll call it so. What is a default financial asset? That is a financial asset that upon its initial recognition, upon its origination, is already impaired as at the time you are purchasing that financial asset. And you ask me, what sense exists in me purchasing a financial asset that is already impaired, as I'm aware that it's impaired and I'm buying it? Such financial asset is what we call credit impaired financial assets upon initial recognition. And I'll give you a practical example in Nigeria. Prior to the financial crisis, we don't have such valid example in Nigeria. But as a result of the financial crisis that occurred between 2008, 2010, and 11 in Nigeria, where we have series of collapse of bank, we now have evidence of such an asset. I believe we are aware of AMCOM. AMCOM is Asset Management Company of Nigeria. Now, AMCOM is known as a bad bank. Have you heard of a bad bank before? Asset Management Company of Nigeria. And AMCOM is synonymous to what? A bad bank. If you have heard of a bad bank before, please raise up your hand and try to take us through your understanding of a bad bank. Can you raise up your hand, please? Have you heard of a bad bank before? Nobody's raising up hand? A bad bank. What is a bad bank? It seems nobody has heard of it before. Okay, a bad bank is a bank or a financial service or financial institution that they specialize in buying delinquent loans. Delinquent loans are loans in default. Remember, CBN created AMCOM to purchase bad loans from those banks so that they can inject liquidity to those banks so that they don't fail. And AMCOM take over those bad loans with the hope of resuscitating them. Such loans, that every loan purchased by AMCOM in Nigeria, are considered credit impaired at origination, because no loan in AMCOM that is a good loan, because AMCOM specializes in buying bad loans. Do you get what I'm saying now? In that situation, you say such loans are credit impaired at origination. Okay, and what is the methodology behind it? Is that if, for example, you are owing GTB Bank 1 billion naira upon accumulation of interest, default, and all sorts of things. Now, to salvage such situation, GTB approaches AMCOM, and AMCOM can buy it for 700 million naira. And AMCOM is discounting it because it's also looking at its risk and portfolio to say, my appetite is that based on the condition of this loan, I don't think I can recover more than 700 million. Therefore, in that case, that forms a basis to which they price that bad loan to say, okay, GTB, you take 700 million cash, I'll take that debt of 1 billion from you. Therefore, it is not the responsibility of ANCON to realize the collateral or to pursue the borrower or to take receivership and all sorts of things in order to recover the money. You can see now, that is a practical example of credit impaired financial asset at origination. Now, these are the practical example of a loss event. Now, let's now go into the granular level of our three-stage model under the general approach. Now, this is how it works. The first question I'll ask myself is, when and how is impairment recognized? When and how is impairment on financial assets recognized under a general approach? The first thing is that I need to categorize. Of all my financial assets, let me say I have over 10 financial assets. How many of them belongs to stage 1? How many belongs to stage 2? And how many belongs to stage 3? Now, at the first point of initial recognition of financial assets, that is when you group them into those stages. And that is when you carry out first impairment assessment at origination, which means you book an allowance for credit loss upon initial recognition. And the minimum amount you can book is 0 when your assessment shows that it is 0, which is also a value. And from 0 upward, you determine what is your allowance for credit loss. Now, upon initial recognition, every financial asset will be classified as stage 1, except for what I told you earlier, credit impaired financial asset at origination will be classified as stage 3. But every other one will be classified as stage 1. On no condition upon initial recognition, you can classify a financial asset as stage 2. No. It's either stage 1 for all financial assets except credit impaired, or stage 3 for credit impaired at origination. Stage 2, you can't enter into these buckets or this group from stage 2. It's not possible. Okay, now you can graduate from stage 1 to stage 2. Your graduation is conditioned upon increase in significant credit risk. That is, when you start to experience significant increase in deterioration of the credit quality of that financial asset. And that is when you move that asset out of stage 1 to stage 2. But the standard also gave us a guidance on how we can easily identify whether there's an increase, significant increase in the credit risk. And this condition is rebootable. What does that mean? This condition can be contested by the entity based on its own unique circumstance. And that is always based on the experience and the nature of industry or nature of the business of that entity. But let's first of all look at the guidance. The guidance is such that whenever you have cash flow to be collected at a specific date, and you're unable to get that cash flow at that specific date, either be it an interest or principal or both or part, and that collection, you're unable to collect it after more than 30 days that it was due. Therefore, it is presumed that such has experienced a significant deterioration. Therefore, such financial asset, I will move it out of stage 1 and put it in stage 2. But if I reboot it, by my nature, I can say in my industry, it is not yet experiencing that, because in my industry, you can experience that only after 45 days or after 60 days. Or some industry, 30 days is too much. The money is gone if it's 30 days. Therefore, some might be 10 days to even prove that anything I'm unable to collect after 10 days is deemed to be lost and have to recover, which means 30 days is not cast on stone, but it's just a guidance to examine whether there is a significant increase in deterioration of the credit quality. Okay, another thing we need to also know is this. If there's an objective evidence that there's a loss event, which we have discussed earlier, it then moves to stage 3. Which means it's only when there's a loss event that you classify from either stage 1 or stage 2 to stage 3. And what it then means is that stage 1, 2, 3 are not necessarily transitory. What it means is that it's not conventional to say I must move from stage 1 to stage 2, and from stage 2 I move to stage 3. No. A financial asset can move from stage 1 directly to stage 3. Imagine somebody that got loan from a bank in February, started business in March. Unfortunately, COVID-19 pandemic occurred late in March in Nigeria, and up to date, the business has crumbled. Remember, initially in March, he has even made the first payment because things were okay. But between April and August, the business is gone or is near death. You can't say he has moved to stage 2. No, this is from stage 1 to 3 because there's an objective evidence that it's just prayer to God for us to salvage the situation. And that is that. And it's also possible to move from stage 1 to 2 and stay in stage 2 until the financial asset is derecognized. Or it moves from stage 2 again to stage 3, which then means it can be from stage 1 to 2 and stays there, or stage 1 to 2 and move to 3 and ends there, or it moves from stage 1 to 3 directly. But remember, we also said impairment can reverse itself, which means there can be reversal of impairment if there is a subsequent improvement in the condition. A situation where the dry bone could rise again. And in that situation, what happens? It then means that a financial asset that was in stage 2 can be moved back to stage 1. The one in stage 3 can be moved back to stage 2. Or in stage 3, it can be moved directly to stage 1. Am I making sense? And that is the position, which means the stage categorization is a function of first, upon initial recognition, all belong to stage 1, except for credit impaired financial asset at origination. And over time, you look at the conditions for you to move from one bucket or one stage to another. Now, the second question I ask is, how is credit losses recognized? And again, before I go further, objective evidence also shows that if you are unable to collect your principal or interest or both after more than 90 days, it means there's an objective evidence that there's a loss event, which means stage 3. But that 90 days is also rebootable because for some companies, even within 60 days, they can classify it as a loss event. And some are extended beyond 90 days and they classify it as a loss event. But the second question is this: how is credit loss recognized? Now, the recognition of credit loss is dependent on the group or stage it belongs. For financial assets classified under stage 1, the assessment you carry out is a 12-month expected credit loss. 12 months means that you are looking into the next 12 months and you are putting off scenario of what is likely going to be your loss in the next 12 months. Because it's stage one, because they are good, which means you don't need to look into the future. Let's just look at the immediate 12 months. But whenever you have a financial asset that falls under stage 2 or stage 3, they are already in a condition that is not favorable to you. Therefore, what do? You rather jettison 12 months expected credit loss for a lifetime expected credit loss, which means don't carry out scenario towards estimating the loss for 12 months. No, estimate the loss over its life to say, okay, if what comes to us on a stress basis, how much can I lose all in all? And that's what we call the lifetime expected credit loss. Now, what is a lifetime expected credit loss? I'll break it down for you. And we are going to see it with analysis. First, let us ask ourselves, what is credit loss? Credit loss is simply a shortfall in your cash flow. What is a shortfall in your cash flow? I gave you a loan of 1 million. And at the point of payment, you can only give me, with your collateral and everything, you can only give me 800,000. It then means that I have a shortfall of 200. That's what we call credit loss. Okay, but what is expected credit loss? Expected credit loss will now factor state of nature or state of the world, which means factor scenarios, such as saying what is the likelihood, which means you start to build in probability. To say, if I'm optimistic, I can get 80% back, which means my shortfall credit loss is 20%. That's how I got that 200,000. But if I am most likely, like I'm in the middle state of the world, I just want to be in the middle, I can say it's likely 60 or 50 or 40. That's another state of the world. And if I'm pessimistic, based on my experience, I can say sometimes the maximum I can recover is 20%. Therefore, I've created a 3-state of nature, which means I've created this 3-state of nature, and I'll have to apply that probability to everyone, or to my cash flow expectation, and use that to derive my weighted average. You know, if you remember when you are doing statistics or doing management accounts, when you do expected value, which means it is the sum of the weight or probability times the factor. And that's what we are talking about here as expected credit loss. Now, what then is a lifetime credit loss? Lifetime credit loss is now a form of expected credit loss that has taken into consideration all possibilities of default and every scenario that can create such a loss event, which means you have considered everything all in all to determine what will be your worst case scenario of the loss you experience over the entire life of these financial assets. And finally, what is our 12-month credit loss? 12-month expected credit loss is a portion or is a part of the lifetime, which is expected to occur only within the next 12 months. Which means a consideration of a 12-month expected credit loss will be lower than a lifetime because you are only looking into 12 months of the future. Whereas in lifetime, you are looking into the lifetime probably is for 5 years. And that is the position of the standard. Now, the third question is this. How is my effective interest rate calculated for financial assets? Remember yesterday we discussed about effective interest rate and how we derive it and how we applied it. Okay, but the question then is, how is our effective interest rate calculated? Because it will be instrumental in discounting our future expectation of cash flows and shortfall in order to obtain the expectation as at today in its present terms. Therefore, which EIR will I use? It depends on the bucket. In the first bucket, which is stage 1, your EIR will be your original EIR, regardless of what has happened, which means it's your EIR at the point of initial recognition. And you are going to apply it on the gross amount. The gross amount of a financial asset is before you deduct allowance for credit loss or before you deduct earlier provision for impairment. Which means you compute effective interest rate on the gross amount as if the asset has never been impaired. And you do that either when you are in stage 1 or you are in stage 2. But when you get to stage 3, the effective interest rate is no longer going to be computed on the gross amount because stage 3 is a delinquent stage. Therefore, you can't be talking of aggregating interest on gross amount when you cannot even get your principal amount. Therefore, what do? You rather apply your effective interest rate on the basis of the net amount, not the gross amount. And what is the net amount? The net amount is the original carrying amount as if there was no impairment, less the allowance for impairment that was already recognized prior to today. And that is what it means. And this process is what we call the general approach to obtaining expected credit loss for financial assets. Before I move further, any question at this level? Kindly raise up your hand. Any question at this level? Any question at this level? Who wants to ask a question or raise up hand? We have 10 seconds to do that. Okay, it seems nobody is raising up hand. Now, what are the parameters we adopt in carrying out impairment assessment? Now, in carrying out impairment assessment, let me share the whiteboard with you guys. Impairment of financial assets. IFRS 9, ECL model, otherwise known as expected credit loss. Now, what this model is simply telling us is that expected credit loss of any financial asset is a function of the following. It's a function of PD is a function of EAD, is a function of LGD, and is a function of time value of money. Now I'll break it down. What is PD? PD is what is the likelihood or probability that there will be a default. Like I told you earlier, state of nature. If I'm pessimistic, it's likely going to default at 80%. It's likely going to default at 40%. It's likely going to default at 20%. I remember probability. It is the expected outcome over total outcome. Remember our probability definition. Okay, which is synonymous to your PX, if you remember your probability description. And you can carry out the probability either on number basis of default or on the value of default. Okay? Now, the second one is EAD. EAD is simply your exposure at default. What does that mean? As at the time there is default, what is the carrying amount of that financial asset at default? Which means this is simply talking about what? Carrying amount, which is equivalent of the what? Gross what? Amount before impairment assessment. Now, what is LGD? LGD is a loss given default. Whenever there's a default, what is the probability or what is the amount of loss that I will experience? Which means what will be the amount of my shortfall in cash flows? And loss given default is always determined by experience of your recovery rate. It's determined by your what? Experience of what? Recovery what? Rate. What is recovery rate? You ask yourself, based on the demographic or distribution or classification of your financial assets that were in default in the past periods. You now look at it based on your historical data to say, when these categories of financial assets went into default, what was my recovery rate? What am I able to salvage? This category of asset on average, when 1 million was the value as at the point of default, with my realization of collateral and all sorts of things, I'm only able to get 40% of it, which means out of 1 million, I'm able to salvage what? 400,000. Which then means that my loss given default is 600,000, which is 60%. And that is why we have a relationship to say my loss given default is 1 minus my recovery rate. Which means if experience shows that I can only recover 40% based on my past data or experience, it then implies that my loss given default based on experience is 60%. What I cannot recover again is what we call the loss given default, or what is deemed to be lost. Okay, now what is time value of money? Time value of money means that the cash flows that we talk about with respect to shortfall are into the future. Okay, and when we are looking at impairment assessment, we are looking at it today. What then do you do? At every point in time when you have expectation of the future and you want to evaluate it today, to look at the condition today, what you then do is to discount those future cash flows. In this case, future shortfalls in the cash flow. You discount it to the present. And what you get is the effect of time value of money. And in that situation, you consider time value of what? Money. Time value of money, consider the effect of discounting. The effect of what? discounting. And that is our position in this case, which means my expected credit loss is the sum of my shortfalls in the cash flow. And what is my shortfall in cash flow? My shortfalls in cash flow discounted by the effective interest rate over a number of periods. Now remember, recall, my discount rates in this case R is equivalent of my what? Effective interest rates. 2, my shortfalls in cash flows is what I call my credit what? Loss. Therefore, I could say my ECL is the sum of the discounting of my credit losses over time, over end period, discounted by what? ERR over end period. And in that case, what I'm simply saying is that my formula for ECL at granular level is the sum of this probability of default multiplied by my exposure at default multiplied by my what? Loss given what? Default discounted by my ERR over M period. And that will give me my expected credit what? Loss. In a simple term. And that is that. Any question at this level? Okay. Any question at this level? If there's no question at this level, let's go back to our presentation slide. Now, as I've said earlier, my expected value will consider probability weighted outcome, which is what I've displayed with you. And it's going to consider time value of money. And the last thing it's going to consider is my data and information, which are influenced by my historical data, my current condition, and my future expectation. All of these are what will form my variables into an ECL model for impairment assessment, especially with respect to the general approach. Okay. And this summarizes it all. For you to see that at initial recognition, you can see that it must be a default of what? Stage 1. Another time you can have stage 3 upon initial recognition is where you have what? Credit impaired. Financial what? Assets at origination. Those are the 2 times you could have upon initial recognition. But you find out that you can move from bucket 1 to bucket 2 under this condition. Or move from bucket 1 to bucket 3 under this condition. Or you can move from bucket 2 to bucket 3. And likewise, you can move from 3 back to 2, or 3 back to 1, or 2 back to what? 1. And those are the explanations that we have given to you. But we are going to demonstrate that understanding with a simple question. Now, let's go back to this question. But before then, let me share the question again for those that might tell me they did not see it. Okay, I'm going to put it in the chat box for all of us to download before we proceed. That's the question I've been using, the practice question, financial instruments. Go to question 8 of it. I hope you have downloaded them. I've sent you that question. Kindly download. And that's question 8. Now, this question 8, let me read it for you guys. When I read it, I'll divide it into 2 groups for you to discuss in 5 minutes in each of the group and come out of the group to explain what really happened and what will you do in this situation. Do you get what I'm saying now? You tell me what has happened. How do you now want to measure impairment, if any? What bucket will you classify these financial assets? And how will you carry out that test? And what is likely going to be the outcome of that test? Now, I read the question, question 8. I believe we can all see the question. Okay, I think I'm sharing the question. Yeah, it's already shared. Okay, the question reads thus. Sorry. Question 8. Arsene Wenger purchased 5% bond in Jose Mourinho on 1st April 2017. And this bond was purchased in the primary market. That is, it was purchased when it was issued. And it was purchased for 1 million naira, which is the face value, probably. The indenture, which is, indenture means the condition and term of the bond issue, was a 5-year maturity with a value of 1,305,350 naira, which is more or less like a maturity value of, that means it will be redeemed at a premium of about 305,350 naira. Now, I told you that when you have a coupon bond, examination purposes, they will give you effective interest rate because there's no way you can determine it in examination. And yesterday, we demonstrated how we can determine it in real life based on trial and error or using spreadsheets, which we did yesterday. If you're interested in knowing how to determine effective interest rate in reality or in practice, go back to part 2 of financial instrument discussion. And all of these are already uploaded on YouTube. Now, the effective interest rate, EIR, on the debenture is 10%. And the IFRS 9 conditions are satisfied for the investment to be carried at amortized cost. As at 31st of March 2019, this is exactly 2 years after, because the year runs from April to March. 1st of April 2017 to 31st of March 2018 is year 1. 1st of April 2018 to 31st March 2019 is year 2, which means within the space of 2 years, Jose Mourinho had filed for bankruptcy and immediately went into liquidation. Now, what happened thereafter? All interest had been paid up to that date, which means interest that were due between April 2017 and March 31st, 2019 are already paid by Joseph Mourinho, which means it's not owing, no past due exists, but it has been affected by a condition, probably because of COVID-19 pandemic. Now he has declared bankruptcy. Therefore, what has happened? I want to know. Thereafter, on 31st of March, the liquidator of Jose Mourinho, has announced a reduction of the remaining interest by 40%. What it simply says is that if I realize anything I can realize from Joseph Mourinho as a company, what I can get can barely pay interest of 40%, which means instead of paying 100% of the interest, it can only afford to pay what? 40% of the interest. And it can only afford to pay 80% of the principal amount. And not that it's able to afford to pay it now. Again, they said this payment will coincide, which means upon realization of asset of Mourinho, which is expected to coincide with the original repayment dates. Which means we are not even saying that we'll pay it now. We are saying that the loan will still continue to run such that at every due date, we will now pay interest and principal, but we are only paying 40% of interest. And when principal is due, we pay what? 80% of principal as full and final settlement, because that is the worst position we have. In that situation, we are also told that as at that reporting date, 31st of March, when all of this information were made available, the market interest rate of a similar bond to Jose Mourinho is 8%. Now, this is the whole of information made available to us. Now, what is the question? The question says, A, what would have been the kind amount of the bond just prior to when it is evident that impairment of the investment has set in? That is, what is simply the gross amount, given that we have not subjected to impairment assessment? Second question is this: considering the possibility of impairment, what would have been the amount to be recognized post-impairment? Which means considering that it has suffered impairment loss, what would be the kind amount post-impairment means? What would be the net kind amount after you deduct impairment allowance from the gross amount? And C says, if any, how will the impairment loss be reported in the books of Arsene Wenger financial statement for the year ended 31st of March 2019? On this premise, I'm going to send you to your various chat room, break room. Okay, I break you into two groups. And please kindly join your group immediately. You have 5 minutes. Your time starts to count now. Let us continue. Welcome back. Now, we won't have enough time for us to do the explanation with respect to your group, but I've tried to listen to what each of the groups have contributed. And what I'll do is to try to attempt to provide guidance and clarification so that we can forge ahead. Okay. And if you have a question, kindly raise up your hand for me to attend to the question. And you can also make use of the chat box to send questions, if any. Okay, let's look at the question one by one. That's question 8. Question 8. Now, how will I solve the question? Let me open my whiteboard. Question 8. Now, the first thing is that we are told to determine our amortized cost, or what is the carrying amount as at the end of year 2. I'll come here to say, A, I show my amortized cost schedule. These are my years. The first year ends in 2018, but starts in March. Second one ends in what? 2019. What is my amortized cost at the beginning of the year at start? What is my interest on the basis of effective interest rates, which we said was 10%. What is my repayment, cash flows? And what is my amortized cost at the end of the year? Now remember, upon initial recognition, I recognize at fair value, which is the purchase price less transaction cost. In this case, there is no transaction cost. Therefore, my interest on basis of effective interest rate is 10%. 10% of 1 million is 100,000. What is my cash flow? Let us come down here and draw up a timeline for my cash flow. My cash flows. This is supposed to run for how many years? 5 years. Year 1, year 2, year 3, year 4, and year 5. This is year 0 in years. My cash flow, I invested 1 million, which went out. In year 1, I'm to get 5%. Year 2, I'm to get 5%. Year 3, I'm to get 5%. Year 4, I'm to get 5%. Year 5, I'm supposed to get 5% plus in Naira value, the redemption amount. Now, which means my 5% interest is 5% of 1 million, which is 50,000 each year. Okay, why my redemption value is 1,305,350 upon maturity. Now, in this case, I go back to say, what is my cash flow received as coupon? 50,000 from this analysis we've done here as at year 1. What is my amortized cost at the end of year 1? It is 1 million plus 100,000 minus 50, which means it is 1 million it is 1,050,000. That's my amortized cost at the end of year 1, which I'll bring forward to year 2. In year 2, what is 10% of this? 105,000. How much will I still collect? Year 2, second interest. I've collected first, I'm collecting second. 50, because we are told that he has paid up to that date. Therefore, what is left? 1,050,000 plus 105,000 minus 50,000, which means prior to impairment test, my carrying amount, which is the amortized cost, as at end of year 2, is this amount, and that represents my answer. That represents my answer for that period. Okay, this is my answer for that period. Okay, B says what? B says question B says, considering possibility of impairment. Now, which means in B, I need to first of all identify why is this malfunctioning? Sorry. I'm coming. It's trying to malfunction. Okay, let me close it and open it again. I pray I've saved this. Sorry, my network went off. Okay. As I said earlier, B requires us to carry out impairment assessment, and so we need to establish stage it is. And we said it's stage 3 because there's objective evidence that a loss event has occurred because of the bankruptcy. Now, what then do we do? We need to estimate our credit losses. What is our credit losses? Which is the shortfall. Our credit losses are the shortfalls in the cash flows. Now, what are the shortfalls? Remember that we have 5 years. And 5. Year 1, we have fulfilled it. Year 2, we have fulfilled it. But what is left that we have not collected the cash flow is year 3, year 4, and what? Year 5. Year 5, there are 2 cash flows, 50 and 1,305,350. Now, we are now told that based on the condition that existed on 31st of March, 2019, we are told that only 40% of this we can salvage. Only 40% of this we can salvage, only 40% of this we can salvage, and 80% of this we can salvage. Which then means that my shortfalls of cash flows are my loss given default. Given that I can only recover 40% of interest, I can only recover 40% of interest. And now come here, what is my short form? Years. I have year 1, year 2, and what? Year 3. Those are the 3 years remaining. What are the expected, what are the cash flows? Contractual cash flows. I'm supposed to get 50, 50, and here, when you add this, I'm supposed to get 1,355,350, if I'm right. But what can I get? Recoveries expected. This I can only get 40%. 40% of 50 is 20. 40% of 50 is 20. 40% of 50, which is 20, plus 80% of 1,305,350. 80% of that is 1,044,280. If I add it together, I have 1,064,280, which means what I can recover here is 1,064,280. What are the shortfalls? What are the shortfalls? 30,000 in year 1, 30,000 in year 2, and in year 3 is 291,070. Therefore, what will I do with these shortfalls? I will apply the time value of money. Therefore, I discount those shortfalls or the credit losses to get my expected credit loss. Year 1, 2, and 3, credit losses. My discount factor, which is the effective interest rate of 10%, and my expected value. What are these? 30 in year 1, 30 in year 2, 291,070 in year 3. Now let me find 10%. If I discount 1.1 raised to power 1 minus 1, I will have 0.9091. In year 2, I will have 0.8264. And in year 3, I have 0.7513. Therefore, let me multiply every 30,000 times 0.9091. It gives me 27,273. 0.8264 times 30,000 gives me 24,792. And 0.7513 multiplied by 291,070. That gives me 218,680. 218,680 plus 27273 plus 24792 gives me 270,745. Therefore, that represents my allowance for credit loss as at 31st March 2019 is what? 277,445. But it asked me for the carrying amount as at that date. The carrying amount as at that date, 2019, will be the gross amount. Remember, what was the gross amount? The gross amount is the amortized cost as at 31st March 2019, which we derive here to be 1,105,000. Therefore, I come down here to say 1,105,000 less my what? Allowance for credit losses. How much is that? 270,745. What is my net carrying amount? $1,105,000 minus 270,745 gives me what? 834,255. And that. Now, C says, what will be the impairment loss I recognize in my income statement? Impairment loss or impairment gain, if any, for the year ended 31st March 2019 will be, I'll compare my allowance for credit loss as at last year, 2018, I'll compare it with my allowance for credit loss as at this year. Last year, we were told it was how much? How much is it? Can we go back to our question? Let me check my own question. Last year, the allowance was okay, we are not giving allowance, which means last year it was 0 because we are not giving that information. This year it is what? 270,745. What is the movement? The movement from 0 allowance to 28 is impairment loss for the year. Is the movement, which is what? 270,745. Supposing our allowance brought forward was 100,000, what we recognize for the year will be what? 170,000. Supposing our allowance brought forward was 300,000, what we recognize is an impairment gain because there's a reversal of about 30,000. And that answers the question. Do we have any question on that? Any question? Can you raise up your hand if you have a question so that I can unmute you? Any question? Okay, Ireti.
Okay, thank you. After there was an objective evidence of impairment, this impairment moved from stage 1 to stage 3.
Yes.
Am I right? And I think,
yes.
So is it still an expected credit loss or a lifetime?
No, expected credit loss is the general name.
Okay.
It is now whether you are carrying out 12 months expected credit loss or lifetime expected credit loss.
Okay.
Do you get what I'm saying? Yeah.
Yes.
Expected credit loss is the weighted average of credit losses based on all conditions that were considered as at that point in time. Why lifetime expected credit loss is when you consider the whole lifetime with all possible scenarios of default. Why 12 months is you only consider portion of the entire life that more or less relate to the 12 months after the reporting dates. Okay. I think Alabi want to talk. Let me give you access. Okay, can you ask your question now, Alabi?
Hello, sir.
Yes.
At the end of March.
Yes. What's the question? I think your network is bad. Agada, you are raising up hand. Agada.
Okay,
Agada, can you unmute yourself? Agada, can you unmute yourself? I think you are not doing that. Okay, I can continue.
I have done it.
Okay.
I have done it.
Yeah.
Sorry, sir, the big part of the question, I'm trying to know where you got the 1355 from.
Is in the question, your redemption value. Can you go back to the question?
Okay.
Now, if you go back there, 1355 is at the date of maturity, you will still collect the last interest. Can you see here? Can you see this place? Let me put it in green.
Yeah.
Can you see here? Is the sum of what is it now? This 50 plus 1305 is that amount.
Okay.
That's why I've already shown you here at the start of it to say, on my timeline, what will you get at the end of year 5? Interest
Okay.
plus the redemption value.
Okay.
Yeah.
Thank you, sir.
Okay. Now let's look at, I told you that we can use simplified approach rather than this general approach. Now let me share the screen back to a simplified approach. Now, simplified approach is using what we call practical expedience. Now, in my simplified approach, what I'm trying to do is that instead of me to go through stage 1, stage 2, stage 3, what I'll do is that when I have financial instruments that are of short term in nature, short term means financial instrument that my period to collecting cash flow or the duration is less than 1 year, or financial assets such that they have no material value up to maturity, or such assets that are receivable in nature, like trade receivable without a financing component, or lease receivable without a financing component, or receivable arising from a contract asset in line with IFRS 15 that does not have a financing component. All of these, I can test them for impairment using simplified approach. And simplified approach use methodology similar to what we call provision matrix. And what is provision matrix? Is that your experience and past data will be used to ascertain what we call your loss rate. Your loss rate will be given by evidence of your loss over the years. And you are going to divide your financial assets, especially receivables, into buckets based on past due days. What is past due date? That is, past due date is if you give somebody a credit of 30 days, and after 30 days he has not paid, such credit is already past due. For every day it has passed your credit days, you start to count what we call past due days, which means if today is now 45 days from the date you bought the goods on credit, but the goods were given to you on credit for 30 days, it then means that your past due day is 15 days. If it is 60 days from the date you purchase and it's 30 days credit, it means your past due day is 30, which means excess of your credit days is our past due days. But if I buy 10 days ago and I have credit of 30 days, my past due date will be current, which means it's not yet past due because this is just 10 days in 30 days credit period I have. Okay, and the loss rate in this past due date will be applied on the carrying amount as at that date. Now, let me show you with this example that we wanted to attempt. Question 9. Okay, I'm trying to look for the question. Okay, probably I've closed it. I have to open it. Let me reopen the question. Can you see the question now? Okay. Now, let's look at question 9. Can we all see the question? If fine.
Yes.
If fine, I can't hear you.
I can see it. I can see it.
Okay, thank you. Now, let's look at this question. It says Green Finance Limited is a service organization involved in specialized training. The company has the following mix of trade receivables which are outstanding along with different dates. That is, some receivables are currently due or past due and others not yet due. As at the reporting date, 31st December 2019, the average credit days for every trade receivable is 30 days. The schedule below represents distribution of trade receivable from the invoice dates. That is when that service was rendered. Now, we have 5 groupings: Group A, Group B, Group C, Group D, and Group E. Invoice dates were given to us. Now, the invoice amount, that is that, amounted to 1,800,000, 500, 1, 2, and 600. But out of those amounts, what is outstanding are 100, 20, 320, and 450. Now, we are told that from our experience, our loss rate estimated by management based on historical loss collection, actual loss on collection, was given to us. For past 2 days, current is 0%. Current means that they are not yet due because they are still within the credit period. 2% for those ones that are past due within 1 to 30 days. 5% for those that are past due between 31 days and 60 days. 10% for those that are past due between 61 days and 90 days. While anything above 90 days, the loss rate is about 40%. Required, based on practical experience and the adoption of simplified approach, that is provision matrix, in accordance with the requirement of IFRS 9 by the management of the company, what will be the amount of allowance for credit losses as at 31st December 2019 to be recognized in your balance sheet and in the statement of profit or loss, given that the closing balance in the allowance account for credit loss as at last year, which was 31st December 2019, was 124,000 naira. Please show the accounting entries, but assume that 30 days make a month. Now, how do I solve this? Therefore, I'm not going to use stage 1, stage 2, stage 3 here because I'm using simplified approach, which is the provision matrix. They've given me the basis of making my provision based on past 2 days. Therefore, what will I do? Is for me, I'll use Excel to solve this. Why? So that it is easy for me to calculate. Now, I've created that schedule on Excel. The same information given to me is on Excel. Therefore, what do I need to do? I need to do the following. 1, I still need the grouping. 1 to 5. Now, I need past due date. Now, past due date is for me to look for how many days between the invoice date, having considered that there's a grace period of 30 days, and I can say this is the maximum of 0, or I'll use a formula, but you can count it by days, which I will show you. Difference between these dates and my reporting dates. Okay, minus 30. The argument is few? No? Sorry. Yeah. So let me check the arguments. Okay. The div. Okay, let me first of all find the date difference. Okay, yeah, I've seen where it went wrong. I didn't calculate in days, my D. Okay, that gives me 305 days from invoice date to the end of the year, but that's not what I wanted. I wanted to know what is the difference in the days after I consider my credit period. My credit period is 30 days. Now I will explain it with our formula. What it simply means is that if you check this, you can use your manual way of calculating. From March 1st, 2019, when is the due date? 30th of March. But as at today, it's owing 120,000. When you count from 31st of March till 31st of December, what you find is 275 days. Now, since I've written the formula, I can calculate for others. And at the end of the day, I could say that these are the periods. Therefore, these are the past due dates. I'll now ask 275 and 211, they fall above 90 days, which means technically, I'll say this falls within this category, 90 days, above 90 days. This falls under what category? Between 61 days and 90. And this falls under what category? Between 1 day and 30 days. Okay, that is the category they fall. Now, what is the outstanding amount or carrying amount before impairment? The carrying amount, if you remember, okay, I didn't do for D, okay, E. E is 0 because it's still within the credit days. This was 10th of December, and we are on 31st of December. I still have additional days within that credit. It's not yet due. Therefore, this one, I'll put it as current. Now, what are the balances? These are the balances. Now, recall, what is the loss rate we are to apply? The loss rate for above 90 days is what? 40%. The loss rate for above 90 days is also 40%. The loss rate for within 61 and 90 days is what? 10%. The loss rate for between 1 and 30 days is what? 2%. The loss rate for current, which means those that are not yet due, is 0% based on historical data they gave us. Therefore, what is our ECL? ECL is now the product, which means you can multiply the product of carrying amount and loss rate. But I think I picked wrong carrying amount. My carrying amount is the outstanding balance, not the invoice amount. Sorry. Therefore, I compute. What is my value now? My value now is what? These are my expected credit loss per each trade receivable. When I sum it up together, how much is it? It is 114. This is my allowance for credit loss. Allowance for expected credit loss as at 31st December 2019. Now, that is that. This is what I will show in my balance sheet. Okay. Now, what will I show in my profit or loss? My impairment loss or gain for the year ended 31st December 2019 is for me to compare in Naira terms my allowance as at 2019 December and my allowance as at last year, 2018. Now, what is my allowance as at end of this year? 114. But my allowance last year, we are told it was 124, which means when you check it, it's a reduction in impairment, which means there's a reversal of impairment loss. And that gives me an impairment for what? Gain. I have an impairment gain, which is a credit, an income. For the year. I'll put it in green because it's gain for the year. And what entry will I pass? Because I already have a balance last year, my accounting entry to recognize this impairment gain is to debit my allowance for impairment account or provision for impairment and credit my profit or loss being the impairment gain. That's my entry. And with how much? I do that with with 9,800 being the impairment gain arising from trade receivables. And that gives us the answer. Any question? If your hand is still up, let me allow you to talk, if any.
Oh no, I think that question is already passed. But you said 9,800 as opposed to 9,600.
9,800. Okay, 9,600. Sorry, thank you. 9,600. Thank you. That's the end of impairment assessment, which means I've shown you how to recognize impairment gain. Okay.
Okay, sir. So the question I'd like to ask is, for impairment, the one we did initially was for the lifetime. If it's not lifetime, we are going to be assuming just the one for 1 year. That's the question, basically.
For this particular question?
No, not with the simplified approach, with the general approach.
General approach. Because we are in stage 3 in general, that's why we did life. If it's stage 1 we only estimate capital recovery and shortfall within 1 year.
1 year, okay.
Yes. Okay, that's why we said 12-month expected credit loss is a portion of the lifetime, contributing the effect of default in 12 months. Is that okay? Now, let us wrap it up. Time is against us. Let us wrap it up with others. Others are descriptive in terms of discussion is what we are going to have. We are no longer going to do any computation at this level. Okay, we move to edge accounting. Okay, even though edge accounting is introduction for financial reporting at ICANN skill level. Okay, I'll just use it to edge accounting, but at corporate reporting level, we'll discuss it extensively and carry out enough analysis on it. Now, talk of edge accounting without talking of edge itself. Edge is an instrument you use for edging purposes. And what is edging? Edging is when you are exposed to certain market risk or market factors or market forces that are outside your control. And you are risk averse, such that you want to edge that risk away so that you can focus on your own business you have control over. Which means edging is a strategy to transferring a financial risk you don't have appetite for or you don't have capacity for. Now, to do that, we usually make use of derivative to carry out edging. But not only derivative to carry out edge, but most of the time we use derivative to edge. If you remember our discussion about derivative, we said derivative is used for risk management purposes in order to edge your risk. But even though today, much of derivative are speculative in nature. Now, the question then is this. What is your edge instrument? What is your edge item? Your edge item is the exposure you have, while your edge instrument is the instrument such as derivative you have written or taken or purchased to manage that risk or exposure. Therefore, for example, if I have a cash flow exposure, I have to repay loan in dollars, but I earn naira. Therefore, to hedge volatility, I can enter into a swap contract, which we discussed yesterday and 2 days ago, where I can more or less enter into a contract for future deliveries of dollar to me at an agreed price, which we have done today. And therefore, what I'll simply do is that my edge item is the borrowing I'm exposed to pay foreign currency, while my edge instrument is the swap contract that I've written on it. Now, the question then is, what then is the role of edge accounting in all this? Because without edge accounting, I will have simply measured my derivative at fair value, and the impact of the fair value goes directly to my profit or loss. Remember our discussion on derivative and its measurements. Okay, but edge accounting is a voluntary accounting that you elect to adopt solely to avoid accounting mismatch. If you believe that without edge accounting, you will have mismatched your cash flows and its impact on your profit or loss. Therefore, entities opt for edge accounting. And what does edge accounting do for you? It tries to ensure that you only recognize the impact of the gain or loss arising from edge at the point when it actually crystallizes or add impact on your financial statement, which means you are going to more or less be given a leeway to ensure that the gain or loss on the edge instrument, which is the derivative, you don't immediately recognize it in profit or loss until the impact of the edge item
affect your profit or loss, which means it gives you an allowance to hold such gains or loss from such derivative and hold it in abeyance in your other comprehensive income, pending when the hedge item, the impact with respect to cash flow or prices affect your profitability in that period. And therefore, you will not bring it back from your OCI back to profit or loss, which means you recycle it. If you remember, in IS1, you classify other comprehensive income into two groups: items that can be recycled and items that cannot be recycled. Example of items that can be recycled is the issue that we have discussed now, which relates to hedge. And we're going to discuss what portion of the hedge gain or loss do we suspend by recognizing in other comprehensive income. Okay, and what portion do we recognize regardless of whether we apply the accounting or not in our profit or loss? Now, that will now lead us to understand that we have three types of hedge. We have fair value hedge, which is hedge against volatility in price of commodities. We have cash flow hedge. Cash flow hedge is the hedge against the cash flows that you have over a period of time, which means variability in your cash flow over a period of time. You want to hedge it. Similar to, I told you about, I have foreign loan, I have to be paid monthly, but I want to hedge against volatility in the exchange rate so that it affects the amount of naira I need to source to pay my loan on a monthly basis. And the last hedge is what we call hedge in the net investment of your foreign operation. That is, this is hedge that you take when you have a foreign operation. What is a foreign operation? A foreign operation could be a foreign subsidiary, could be a foreign associate, could be a foreign joint venture, it could even be a foreign branch or a permanent establishment. And in that case, what do you do? Because I have a subsidiary in Ghana with Ghana cedis, and I'm a Nigerian company. Therefore, I have a foreign exposure, which you call a translation exposure, because at the time I will be consolidating the Ghana results. Remember, the movement in exchange rate will surely affect my value, whether up or down. And upon realization of the investment, imagine I invest 1 million Ghana cedi today at the rate of 100 naira, which means I invested 10 million naira, 100 million naira. At the point of disposing that subsidiary, imagine I dispose it for 1.2 million Ghana cedis. Naturally, I've made a gain of 200,000 Ghana cedis. But when I convert it to naira, I might make a loss because as at the time I'm bringing the money back to Nigeria, the Nigerian naira has appreciated against Ghana cedi, let me say at 70 naira per Ghana cedi. 70 naira per Ghana cedi multiplied by 1.2 million Ghana cedi will give me 84 million naira, whereas I invested 100 million naira. Therefore, that is what I'm trying to hedge. And to do that, I can take derivative and I can use other instruments like financial borrowing to perfectly hedge and create what I call a natural hedge. Okay, these are the type of hedges we have: fair value hedge, cash flow hedge, and net hedge in net investment in foreign operations. Let us take note of that. Okay. Now, there are conditions you need to fulfill before you can adopt hedge accounting. It's not compulsory, but if you choose to adopt that accounting, you must follow it strictly. And the first thing is this: you must determine from the risk management perspective whether the relationship between the hedge item and hedge instrument has economic attributes or they are economically related in substance for you to qualify for edge accounting. Otherwise, you can't apply edge accounting. Another thing you need to ensure is that there must be edge documentation preceding entering into edge. And how you want to manage that edge, in part or in full, with respect to the risk component you are trying to edge, must be defined. How you will measure the effectiveness of the edge must also be defined. And how you carry out what we call backtesting, whether it is highly effective for the edge account. These are the things that what consider. And you also consider edge relationship to the extent of ascertaining the effectiveness, looking at one relationship between the edge item and the edge instrument. What is the effect of credit risk, given that it dominates value? And finally, what is the edge ratio, so that it will assist you whether it is effective or not. Which means if I have exposure of 1 million Ghana cedi, I might not want to hedge everything. I might want to hedge 60% of it and take risk of 40%, which is in constructing or in acquiring or writing a contract for my hedge in such a way that it only set my risk for 60% of my portfolio. And that's what we're talking about. Now, how do you discontinue edge? When it's no longer effective, therefore, you are allowed to discontinue the edge. Okay, which means you can only discontinue edge when it's no longer effective, or when the condition or criteria that you satisfy early on when you are trying to adopt edge accounting no longer exist, are no longer met. You discontinue the edge. Okay. Now, which then means that that is our position at that point in time. Now, as I've said earlier, you can see it on the screen now. I have discussed about fair value edge. I've discussed about cash flow edge, and I've also discussed about edge of net investments in foreign operation. Okay. Now, for a fair value edge, the gain or loss of the edge instrument will be recognized in profit or loss, or OCI, if the edge relates to equity investment that is measured at fair value through OCI. Which means whenever you carry out a fair value edge, the impact of the edge instrument must go into your profit or loss, because already the impact on the edge item, which are the measure at fair value, already affect profit or loss. The only exception to it is that if what you have hedged is equity investment that was measured at fair value OCI, it then means that the gain or loss on the edge instrument must also go to OCI in order to avoid mistakes. Whereas if it is cash flow edge, what you need to do is to carry out assessment of effectiveness. What that means is that you consider the gain from edge item with the loss on edge instruments, and vice versa, because they are opposing conditions. In that case, what do you do? Under IAS 39, we consider a band to say it's effective based on show 80% to 125%. Once it falls within that band, we say it's effective. Once it goes out of that band, we say it's ineffective. Now, when you carry out such effectiveness test, which you call edge effectiveness, when you carry out the test, and let us say out of the fair value of 100,000 naira, 80% of it is effective, while 20% of it is ineffective. The 20% of it, which is 20,000 naira that is ineffective, will be recognized directly in profit or loss, while the 80%, which is 80,000 that is effective, will be warehoused and reported through other comprehensive income. pending when in future, when the edge item has cash flow impact that affect your profit or loss, you will now recycle what you have more or less recognized in OCI over time to your profit or loss. Okay, and for net investments, okay, all your portion of the edge instrument gain or loss will equally be recognized in OCI because the foreign operation has yet been realized until the impact of that affects your profit or loss before you release such portion to your profit or loss. And that is a simple discussion on edge accounting. At this level, we won't be able to demonstrate with practical examples or problem solving. But by the time we do a section for edge accounting extensively under corporate reporting, we'll look at practical questions, illustration, and scenarios. And let us end this class with our discussion on disclosures with respect to financial instruments. IFRS 7 deals with the disclosure for financial instruments. Remember, financial reporting entails what I call as acronym RMD. What is RMD? RMD is not what you are used to in Nigerian movie setting, but RMD in this case means recognition, measurement, and disclosure. Now, disclosure is an integral part of financial report because that is how we get to understand more and have a better appreciation of the information contained in recognition and measurement. Similarly, when we discussed IS1, we said there are 5 components of financial statements. Statement of financial position, statement of profit or loss and other comprehensive income, statement of changes in equity, statement of cash flows, and note in financial statement. And we said they are all of equal prominence. Note in financial statement is like a disclosure to make users of financial report have better knowledge of that financial statement so that they can make meaningful decisions. Similarly, for financial instruments, we have done measurement, we have done classification, we have done recognition, we have done everything we need to do. And that has flowed into our financial statement and account. But now we need to provide the user financial report more information for them to gain more understanding about the financial instrument we have, about how we manage the risk associated with that financial instrument, and to also allow them to see how sensitive changes in the underlying of variables or market factors could erode or increase profitability. On that basis, IFRS 7 now provides us with the following disclosure, which I've summarized on this presentation slide. Your disclosure comes under 3 levels. The first level is that you disclose the classes of your financial instruments and the level to which you fair value them. Remember, fair value measurement, IFRS 13, talks about the hierarchy level of fair value. Level 1, level 2, level 3. Let me quickly show you, even though we are not going to discuss fair value in full today. Now, this is what I meant. There are 3 hierarchy levels for fair value. Level 1, level 2, and level 3. Level 1 is your quoted market price, which is observable. Level 2 is your quoted market price, but in this case, has been adjusted for observable market data, which means it's closer to level 1. And level 3 is unobservable input, which goes in by way of estimation, valuation of market factors. And in that case, we say we have 3 levels. And of the 3 levels, level 1 is the most valuable level of it all, followed by level 2 and what? Level 3. which means reliability is at level 1, followed by all other observable inputs at level 2, and followed by little or no observable input by level 3. Okay, now let's go back to our discussion here. Therefore, which means you disclose the categories of your financial assets and liabilities. Those that are held at fair value to profit or loss, those that are held at fair value to OCI, those that are held at amortized cost. Likewise, your financial liability and what are their fair value, and on what basis do you fair value it? Is it at level 1? Is it at level 2 or at level 3? And at this disclosure level, remember that we don't measure amortized cost for assets at fair value. But for disclosure purposes, we will disclose the fair value alongside with the amortized cost, just for the users of financial statement to have a feel of what the market is saying about this financial asset. Second level is to discuss the significance or disclose the significance of financial instruments under 3 groups. 1, you disclose the significance of financial instrument on your balance sheet. 2, you disclose it based on the effect on your financial performance, which is on your profit or loss. And 3, other disclosures that borders on your accounting policy for financial instruments, your hedge accounting if you voluntarily adopt it, which we just discussed, and your fair value that you have done. Now, for balance sheet effect, you need to disclose the category as we have said earlier. You need to show us financial assets that you measure at fair value to profit or loss. You need to give us details of any reclassification you have done as regards financial assets for the reporting period. You need to give us details of financial assets that were derecognized in that period, whether by way of transfer of significant risk and reward, or for a liability that has been discharged, that has been cancelled, or has been settled. You also disclose collateral that exists and the form of collateralization or securitization you have for all your financial assets. You also disclose allowance for credit losses, like what we just did under impairment assessment. If you have a compound instrument, especially with those that have multiple embedded derivatives, you disclose them. And finally, for every default and breaches that exist, you disclose them and how that affects your measurement of financial instruments and recognition of impairment or credit losses in the books. Now, under the income statement, item by item, you disclose the income and expenses attributed to financial instruments. That's why you see things like finance costs separated within the income statement and finance income or investment income separated, because you have to have that idea. And also, like impairment assessment is also shown separately. Okay, and that is that. Now, for the third level is to discuss the nature and extent to which you manage your financial instrument risk. Remember, we have 3 categories of risk we manage in financial instruments. The first one is credit risk. Credit risk is the risk of default, which leads to impairment assessment, because you are unable to recover all of the cash flow you're supposed to get from that asset. Second one is liquidity risk. Liquidity risk is a form of market risk, or because at the point you want to realize your financial assets, you are realizing it under unfavorable condition because the market is pricing it below what it's supposed to get, probably because the market is inactive or the market is inefficient as at that point in time, or you are unable to sell at the appropriate time you want to sell. And also, we talk about market risk. Market risk deals with other market factors, like the impact of FX rates on your financial instruments, the impact of changes in interest rates on your financial instruments, and the impact of changes in market prices and factors on your financial instruments. These are what to disclose at qualitative level and quantitative level. Qualitative level is to describe the ways and manner you manage it through your enterprise risk management, which you call ERM. Quantitative disclosure is disclosing it through statistical tools and measures and metrics, such as VAR. VAR means value at risk, such as standard deviation, such as variance analysis, such as using percentile quartile to represent your risk management measures. And all of these are what we also use to disclose quantitatively the effect of risk on our financial instruments. And lastly, part of what we also do is to conduct sensitivity analysis, saying that given that my interest rate increased by certain basis points or percentage, what will be the effect on my financial instrument and my profitability or loss? What if exchange increased by 5%, Naira depreciate by 5% or appreciate by 5%? Which means we are carrying out what we call a scenario analysis to see how sensitive market factors affect your financial instruments such that it affects your bottom line with respect to profit or loss. And on that premise, if there's any other question, kindly raise up your hand and ask for us to end this. Any other question? Kindly raise up your hand for us to end the session. Nobody's raising up hand. I'll give you the next 30 seconds. Any question? Any question? 20 seconds to go. Okay, Dari Alabi, what's your question? What's your question? Dari, I can't hear you. Okay, who else wants to ask questions? Since Dari is unable to unmute. Who else wants to ask questions? Okay, in the absence of no question, thank you very much. I'm going to share the exact slide and also share the solution slide or our whiteboard slide with you guys for the solution. And I believe all of you have the presentation slide already. And if you don't have it, let me try and upload it before. Let me try and upload it. Just give me 1 minute as we upload. Please ensure you pick it up. Okay, kindly pick it up. It's already dropping. Now let me also give you the solution slide for the solution slide of what we have been doing since. Okay, I'm dropping the solution slide. I've also dropped that and the Excel.
Please kindly download it and share it with your other colleagues before. Okay, I've shared it. The Excel has gone. The presentation slide has gone. The solution slide has also gone. And let me put again the practice question for those that may not have. And let me put, and I want you to read this practice question, a comprehensive question, which has solution so that it gives you more understanding. I'll show you to you now. I've attached it, but let me demonstrate it. I think I sent it to you before, but I'm showing you now. Now, please, I want to hear all of you that, please, let me hear that you have gotten all the slides. Let me know, please. Confirm to me whether by chat that you are mute and confirm. Have you seen all what I've sent to you? If I have you seen?
Yes, sir, but it hasn't finished downloading from my end.
Okay, ensure it downloads. Omome, have you seen it? Agada, David, Flynn, Shode,
No, not
and
yet,
Co.
sir.
Whether it's taking time to drop, nothing has dropped at your end.
Yes, sir.
That means your network might be slow.
It's also possible that those using mobile phones cannot
okay,
get.
No. You can't expect it on mobile phone. I don't think so. You should use laptop. But again, I'll still share it in all of those other WhatsApp platforms and send to you. But you can also discuss with your colleagues that logged in through computer. You will see it there. And on your screen now is a question I equally gave to you before the start of this class. And what I've done is that I've added solution to it, which explain all of the general model we have talked about, general approach, stage 1, stage 2, stage 3, and credit impaired model that goes with lifetime expected credit loss. Kindly follow it through. And on that basis, we'll call it a night. Thank you very much, and God bless you. Good night, everyone.